In this video, I'll be covering off how to fill the tax return for a partnership, given that you should have watched first how to prepare the special purpose financial reports for the partnership, because from this video you will get an idea as to what data it is that we're working with, and that will give you some better idea as to what this all means when I fill this partnership tax return. So we started with this Excel report, and we're able to produce from the Excel report the profit and loss and balance sheet that we imported into Logit, and you can see it's got the logo for the XML file that we use for this particular example. So now let's have a look at how we'll work with the form. I'll come over here. I'll remove that 2019 form, and I'll start again with adding the 2019 form. So select the year, pre-fill, give it a moment to pull in the data. You'll notice here that it doesn't activate the interest and the dividends. So let's just click complete on that. And we do actually have interest and dividends in here, but it doesn't pick them up. So let's just have a look why. So go to income. We don't see any income, interest and dividends, and yet we do have interest and dividends, because if we look inside the reconciliation section, and also if we go back and have a look at what was in here, you can see we've got dividends, we've got interest earned, right? So back into the form, and if we have a look in the reconciliation section, so we're starting in the reconciliation section to see what wasn't picked up, what wasn't handled for. You can see we've got interest and dividends in the accounts, and these become an adjustment through the reconciliation section, so less the accounting investment income, right? So what we want to do is activate the section for interest and dividends. Once those sections are activated, we'll have a better ability to control for what we want there. So you can see we've got interest and dividends in the gross interest. And you can see one more thing here that's worth noting is the dividends have mapped into the interest section. So I'll fix those. I'll open that in a new tab. I'll jump across to the new tab. Dividends went to interest, so I need to fix the dividends. Go back to the form, so back in the form, right click on the screen, reload. So I've pressed the reload, and now you can see we've got XML value interest from the accounts. We've got no tax value. We need to report the tax value. And maybe there were some TFN credits. So maybe there was, say, $3 of TFN credits there, right? At least now you can see there's no difference on the interest. So there's only, well, actually, let's have a look at this after we fix for the dividends. So back into income, dividends, and here we've got the dividends in the accounts, but the system doesn't know what the dividends are for tax purposes. And maybe there were some franking credits. So I don't know what that could be, probably say $20 or something. There is a ratio there, but I'm not too worried about that now. Just showing you how this will flow through. Notice the franking credits will reflect, and we'll still end up in a difference scenario. So when we go to reconciliation now, what we're seeing is the accounting profit, and I'm going to jump back across to the accounts and show you the financial values imported. So interest, dividends, right? Back over here, also noting the accounting profit. So scroll all the way down, make sure we know what we're talking about. So what came in from the accounts that we imported, 4806, right? So 4806, I'll go back to the tax form, and here you can see in the reconciliation section what we're doing is we're reconciling off between the accounting value and what will ultimately be the taxable income. So there's going to be a difference, and we can see some of the reasons for why these differences may arise, particularly with how we had to deal with the adjustments for tax and accounting. So you can see now the investment income, income from dividends, income from interest, compared with the accounting income, interest and dividends, right? So there's $90 worth there, and there's $110 there. So you can see there's a difference, right? And the difference is that here, inside of the tax value, income from dividends is the grossed up value. So let's just go back and see inside of income, dividends, 75 plus 20 is 95. So the system will gross up your dividend value with the franking credits, hence why we end up with 95 compared to 75. The interest is the same, 15 and 15. And you're using this reconciliation section to find what the differences are and make sure that you understand what they are. Right, so now we've got another difference here that we need to understand. And this difference is, this one's a little bit more complex, because let's go back to the accounts and see what we have for depreciation. So in the accounts, we've only got $8,500 worth of depreciation. And if we see where that $8,500 went with respect to classification, and we look down through here, we see we've got depreciation general pool write-off. Now this would be very unusual to see any scenario like this, but it will help you to understand how this reconciliation section's working when it comes to depreciation. In the form, let's have a look at what's happening in the depreciation module. We've got the accounting value for depreciation, and it just so happens that for tax purposes we've got a whole lot more. We've got a whole lot of depreciation coming through from the depreciation module. I'll jump over to the depreciation module and show you what's in there. So load up the depreciation report, give that a second, and you can see we've got all kinds of depreciation coming through for tax purposes. So the Logit system uses the Logit depreciation module to compute and introduce the tax values. So these are taxable depreciation values, and we've only got a small amount of accounting depreciation values. Hence there's actually a big difference between the two, to the tune of nearly $50,000. And if we so happen to jump over to the reconciliation section and have a look in here, remember we've got our accounting profit, and we've got an expense reconciliation adjustment for depreciation. So what is this actually saying? It's saying that there's a difference between the accounting depreciation and the tax depreciation to the tune of nearly $50,000. And if we factor that in, you can see we end up with a taxable loss, because the expense reconciliation adjustment actually increases the tax deductions, and hence we end up with a whole lot more, 8,940 in the way of losses for tax purposes. And that then means that when we come over to the partners, what we want to do is just split out. We can simply split out that loss, And you can see how you split it out. You split out the franking credits and the TFN credits and the frank distributions and the rest of the lot. So these actually show as profits. This value shows as a loss. And we just do that. We split it amongst the partners in their respective partnership ratios. In this case 50-50. And we have ourselves a completed tax return for a partnership. And in this case, we've understood what's happening through the reconciliation section.